Imagine waking up one morning, glancing at your phone, and seeing the numbers next to your favorite tech stock plummet so sharply it feels like a punch to the gut. You remember that moment vividly because it was the day I realized how fragile my sense of financial security really was. It wasn't just about losing money. It was about confronting my own assumptions, my confidence, and ultimately, what I thought I knew about investing in an industry that seemed unstoppable. You might think tech stocks are a safe bet. After all, they shape our world every day. But standing there, watching those digits drop, made me question everything. Why did this happen? How could something so promising suddenly become a nightmare? What lessons were hidden beneath those losses? I want you to picture yourself in that situation, not just as an observer, but as someone who's poured hopes, savings, and trust into companies branded with sleek logos and groundbreaking ideas. Because when you lose money in tech stocks, it's not just dollars disappearing. It's dreams deferred and confidence shaken. The roller coaster ride of highs filled with euphoric gains followed by heart-dropping dips is more than just market volatility. It's a personal journey through fear, hope, disappointment, and resilience. What if instead of letting those losses define me or stop me from moving forward, I chose to learn from them? What if every painful dip became a stepping stone towards smarter decisions rather than regret? That's exactly what happened. Behind the scenes of every headline-grabbing crash or surge lies an opportunity to understand market psychology in ways textbooks don't teach us. The emotional traps we fall into when greed blinds us or panic drives us to sell too soon. You'll hear stories from investors who lost fortunes yet found clarity afterward. Mistakes made not out of ignorance, but human nature itself. Insights gained only after enduring sleepless nights staring at red numbers on screens. This isn't some textbook lecture on finance. It's real talk about how the tech sector tests patience and sharpens intuition like no other market can. By sharing these experiences candidly with you now, raw and unfiltered, I hope you'll see beyond the headlines and hype surrounding technology stocks. There's wisdom buried in loss if you're willing to dig deep enough for it. And maybe, by hearing what I learned through losing money on these volatile investments, you'll walk away better prepared for your own journey ahead, ready not just to survive, but thrive amidst uncertainty where others falter. I want to share something with you that changed the way I think about investing. What I learned from losing money in tech stocks. It wasn't just about watching numbers drop on a screen. It was about understanding the emotional roller coaster and the hard lessons behind those losses. When I first jumped into tech stocks, I was drawn by stories of overnight millionaires and sky-high valuations promising endless growth. Companies like Tesla, Zoom, or some lesser-known startups seemed like golden tickets. But reality hit fast and hard. Imagine buying shares of a hyped company right before they release disappointing earnings or face unexpected regulatory hurdles. One moment you're riding high on optimism. The next, your portfolio's value plummets 30% in days. For me, holding onto these stocks felt like gripping a burning rope. I wanted to let go but feared missing out on a rebound that might never come. That fear, it's called FOMO, fear of missing out, and it clouds judgment more than you'd expect. One particular example stands out. An investment in a well-publicized cloud computing firm that promised revolutionary technology but failed to deliver consistent profits for years. At first glance, their innovation seemed unstoppable. Everyone was talking about their potential to disrupt entire industries. Yet, as quarters passed without tangible returns, my confidence wavered. But instead of selling early when losses were manageable, I held tight hoping for a miracle turnaround. This experience taught me critical things. First, hype isn't a strategy. It's noise until backed by solid fundamentals and realistic business models. Second, diversification isn't just advice. It's survival insurance against unpredictable market swings inherent in tech sectors prone to rapid change. Third, Emotional discipline matters more than chasing trends because panic selling during downturns often locks in losses unnecessarily. Reflecting now, those setbacks didn't just teach me caution. They equipped me with resilience and sharper analytical skills for evaluating future opportunities realistically rather than emotionally chasing shiny prospects alone. You'll find this too if you allow yourself space to learn from what feels like failure rather than burying those moments under frustration or denial. So when volatility shakes your investments, and it will, remember these lessons aren't roadblocks, but stepping stones toward becoming smarter and steadier through the stormy seas of tech, investing where many stumble but few truly thrive beyond their mistakes. Think about the moment you first saw a tech stock soar. Maybe it was a startup promising to change the way we live, or a giant unveiling its latest gadget. That rush, that excitement is intoxicating. I've felt it too, and I've also felt the sting when those same stocks plummeted, wiping out gains faster than you can say. Market correction. The lesson here isn't just about numbers. It's about understanding what drives those numbers and how emotions can cloud judgment. Take the case of Snapchat in 2017. Early investors were caught in a frenzy over its potential. But when earnings didn't meet sky-high expectations, shares tumbled dramatically. It wasn't just bad luck. It was impatience and over-optimism. One hard truth I learned is that no matter how groundbreaking the technology seems, be it AI, blockchain, or quantum computing, the market's reaction often hinges more on timing and sentiment than pure innovation. Remember Tesla's wild ride? Investors who bought at peak hype only to see volatility shake their confidence had to confront harsh realities about market cycles and speculation versus actual profitability. What changed everything for me was shifting focus from chasing trends to studying company fundamentals deeply. Revenue streams, cash flow stability, management credibility, not just headline. Another eye-opener came from watching friends get burned by hot tips on emerging tech firms lacking solid business models. It's easy to fall for stories of disruptive genius until reality sets in. Many startups burn cash rapidly without sustainable paths forward. This taught me discipline, setting clear entry and exit points based on realistic valuations rather than hope alone. Prevents emotional decisions when panic sells strike. Moreover, diversification isn't some boring advice reserved for cautious retirees. It's survival strategy during tech sell-offs. When my portfolio was overly concentrated in semiconductor stocks before global chip shortages hit supply chains hard last year, losses piled up quickly. Now spreading risk across sectors and geographies, cushions against shocks that single industries face suddenly. Finally, patience became my greatest ally. Not blind holding on to every dip, but measured resilience with periodic reassessment aligned to long-term goals, instead of daily price swings. Tech investing will always be volatile because innovation itself is unpredictable. Embracing this uncertainty while learning continuously turns mistakes into stepping stones rather than stumbling blocks on your journey ahead. When I first plunged into tech stocks, I thought I was riding a wave destined to crest forever. The excitement around new gadgets, groundbreaking software, and artificial intelligence promised endless growth. But the reality hit hard when several companies I invested in faced unforeseen hurdles. Regulatory changes, missed product launches, or simply market saturation. One company that seemed unstoppable suddenly lost half its value after a failed product update. Another promising startup evaporated almost overnight due to cash flow issues. These experiences taught me that being enamored with innovation is not enough. You have to understand the underlying business models and their sustainability. I remember putting a significant chunk of my savings into a cloud computing firm that had been all over the news for its explosive growth. Initially, it soared as expected, but then stumbled when competitors offered similar services at lower prices. Watching those numbers drop was painful but eye-opening. It highlighted how quickly competitive advantages can erode in technology sectors. This realization shifted my approach from chasing hype to seeking companies with strong fundamentals, solid revenue streams, adaptable business strategies, and leadership that could pivot intelligently under pressure. Another lesson came from observing how external factors beyond tech alone impact stock performance. For instance, geopolitical tensions affected semiconductor supply chains dramatically, a crucial component for many tech products, causing ripple effects across multiple investments simultaneously. It dawned on me that even the most innovative companies aren't immune to global economic shifts or policy decisions. One practical adjustment I made was diversifying within the tech space itself, rather than concentrating on just one niche like social media or hardware manufacturing. By spreading investments across various subsectors such as cybersecurity firms, cloud infrastructure providers, and AI research labs, I reduced vulnerability while still participating in technological progress. Mistakes also forced me to develop patience and resist impulsive reactions during market dips. Selling at the first sign of trouble often locks in losses unnecessarily. Sometimes holding steady through volatility allows time for recovery when fundamentals remain intact. Ultimately, losing money taught me humility and respect for how complex this industry is. Success demands more than enthusiasm. It requires continuous learning about evolving trends and risks, combined with disciplined decision-making grounded in facts rather than emotions. Every setback became an opportunity to hone judgment so future moves could be wiser and more resilient against inevitable uncertainties ahead. Every setback became an opportunity to hone judgment so future moves could be wiser and more resilient against inevitable uncertainties ahead. If you take a moment to reflect on your own experiences, maybe you'll see that losing money, especially in something as volatile as tech stocks, isn't just about the financial hit. It's about what those losses teach us when we're willing to look beyond the immediate sting. I learned that decision-making grounded in facts rather than emotions is not just a strategy. It becomes the foundation for long-term growth, both financially and personally. When you allow fear or greed to dictate your moves, you're essentially handing over control of your future to unpredictable forces. But when decisions come from careful analysis and a clear understanding of risks, even losses transform into lessons rather than regrets. Imagine approaching investments with the mindset that each downturn is feedback rather than failure. A signal pointing out where assumptions might have been off or where patience needed strengthening. That shift alone changes everything because it invites curiosity instead of blame, resilience instead of defeat. You start seeing patterns, recognizing market cycles, and appreciating how external factors reshape industries overnight, all without letting anxiety cloud your vision. This clarity doesn't mean you become immune to loss. It means losses no longer define you or derail your progress. What stands out most from my journey isn't the money lost, but the wisdom gained, learning when to hold tight during turbulence, and when to cut ties before damage deepens. Understanding diversification isn't just jargon, but a shield. Realizing that technology's rapid evolution demands constant education, not complacency. Knowing, too, that patience often trumps impulsiveness in building wealth. These insights are priceless because they extend far beyond stocks. They apply wherever risk exists in life. If I could share one truth with you now, it's this. Setbacks don't erase potential. They sharpen it, if only you're willing to absorb their lessons fully. Losing money taught me humility, without surrendering hope and caution, without succumbing to paralysis. It showed me how crucial emotional discipline is amid chaos, and how embracing uncertainty can lead not away from opportunity, but toward greater preparedness for whatever comes next. So next time things don't go as planned, especially in moments when stakes feel high, remember this story isn't unique. It's universal among those who dare navigate complex paths toward growth. Let every loss remind you that true progress lies not simply in winning, but in evolving through challenge, transforming pain into perspective and doubt into determination. That's where real strength lies, quietly waiting for your command.